Right now, we got futures holding around the flat line after the Dow struck a record yesterday. Joining us now, we've got Cameron Dawson, Chief Investment Officer, New Edge Wealth. Cameron, I always love getting the chance to talk with you. All right, let's talk about this melt-up of market. I know often so much attention is paid to the S&P 500, but the Dow did strike a record. The S&P 500 still in spitting distance of that. What do you think about this melt-up? Can it continue?
We think the best thing for this market to continue rallying is just that you have positioning that still remains pretty light. One of our favorite indicators is the Deutsche Bank Consolidated Positioning Report. And a couple weeks ago, it was in the 70th percentile. People were getting overweight. But because we've had a little bit of volatility, that quickly moved to the 40th percentile. So you still have this market and institutional investors that are fairly skitterish. It doesn't mean that sentiment and positioning is light everywhere. One thing that we're watching really closely is how extended positioning and sentiment is getting more in retail. You've seen leverage go up pretty significantly. You see things like options activity show that people are only really contemplating upside, not necessarily downside. So there's certainly signs that some of that is extended, but there's a big, huge institutional cohort that likely still has to chase this market higher.
That's a great point. That's one of the things that I was thinking. One, and then two, the patterns that you see in the fourth quarter. And then, oh, by the way, earnings are still overall much better than expected. You do point out that valuations are what you call, quote, nosebleed level. So how should a long-term investor think about this?
Yeah, valuations are important, but they are a terrible timing tool, meaning that they can go high and stay high, or they can go low and stay low. And our preferred way of thinking about valuations is not necessarily a sign as to whether or not the market can keep on rallying, but more as an amplifier once a catalyst emerges. And what I mean by that is that let's say we do see some kind of growth scare. The fact that we are in a higher valuation level today likely amplifies the potential downside. But to your point, as you continue to see earnings come in better than expected, when you see earnings revisions move higher, that's usually a good environment for valuation expansion. So as long as this economy keeps chugging along, as long as earnings continue to deliver, you can see valuations levitate in these nosebleed levels. The challenge will become if you start to challenge those growth narratives, that's when valuations will likely to compress. And because they're starting from a high point, they have a lot of room to fall when or if that happens.
Okay, you mentioned the data point earlier, the Deutsche Bank data point, and it makes me think of the largely economic data blackout that we've been. We'll get finally CPI this Friday because they have to make an adjustment on the cost of living, which is great that we'll get that. What's your take and how have you been navigating with very limited economic data?
We think that we've been having to turn to alternative data sources, which do suggest that you are still seeing a continued deceleration in the U.S. labor market, but we're also taking our cue from what equity markets are saying. And one of the things that we're watching really closely is the ratio of cyclical stocks versus defensive stocks. So a great example of that would be something like the equal weight consumer discretionary versus consumer staples. And as long as that ratio remains in an uptrend, we think it's a message from the equity market that they're still fairly sanguine about the U.S. consumer outlook. If that ratio starts to break down in a more meaningful way, it stumbled in the last couple of weeks, but still very much remains in an uptrend. But if that breaks down, that would likely be a sign that the equity market is growing more concerned about the consumer outlook. So that ratio being an uptrend is one of the reasons why we've remained optimistic about the U.S. consumer. And as of right now, it's still sending that sign of optimism.
Okay, when we were getting into going to break, talking about our interview with you, one of the things we talked about are the flies in the ointment, and you're paying attention to that. What are the flies in the ointment that you're watching out for?
Yeah, we're watching some of those frothy signs of sentiment starting to bubble up. I mentioned earlier things like options data is starting to show signs of things like put-call ratios where people really aren't wanting to price in or contemplate any kind of downside. We're watching the bond market really closely. We think it's really fascinating that for all this talk about great growth coming from AI capex, as well as a U.S. economy that's continuing to grow, look at that Atlanta Fed GDP now still at 3.8%. And all of that rolls together and you have a 10-year treasury yield that's sub 4%. That suggests that maybe the bond market is pricing in a more dire growth outlook. And so we have to watch that in addition to some of these ratios, as I mentioned as well, cyclicals versus defensives. If those start to break down, that could be a sign that there's a big leadership change happening in the market. So all things that we're watching closely, nothing that's necessarily flashing big red lights right now, but it does require vigilance.
Is there room to get frothier, though, Cameron?
Oh yeah, I mean the party can always keep on going, and I think that the reality is that because you're in that 40th percentile in the institutional positioning, that just suggests that there is a lot of room for institutional investors to get dragged kicking and screaming into this market, which just means that you could see valuations continue to expand higher, press into new highs. It doesn't mean it's sustainable. It doesn't mean that it's healthy. It doesn't mean that it's good for forward returns. But in the near term, that light positioning just means that the party can keep on going on.
Speaking of the party, let's talk a little bit about small caps. They finally had played some catch up this year when you saw the Russell 2000 hit a record as well. What's your view on that, especially when you think about, not all members of the Russell 2000 are created equal, right?
No, I mean, to your point, they're not created equal because 40% of them don't create any profits. And we think that the small cap story is not about fundamentals. If you look at the fundamentals of the Russell 2000, you are still cutting earnings estimates, and you've been consistently cutting earnings estimates for the next forward 2 years over the course of the last few years, meaning that you continuously have this earnings revision down cycle. But the best thing small caps have going for them right now is that nobody loves small caps. You have ETF outflows, despite the fact that you've had about a 45% rally off the lows from April, you still have people selling their ETF small cap exposure. So because there still are these rolling outflows in small caps, it just means that the pain trade is likely higher. And we've seen that multiple times over the course of the last few years. The fundamentals haven't changed. You've kept cutting earnings estimates, but you have massive positioning rallies as people chase into the sector. And so we would think that the small cap rally could likely halt once you see those ETFs switch from outflows into inflows, but that's not quite happening yet.
Cameron, can I get a quick 30-second thought for you on the Fed and where it goes, especially just in case, let's say CPI actually comes in hot. Is the Fed still, kind of stuck with having to do a 25 basis point cut?
Yeah, we think that they will cut in October, even if you get a bit of a spicier inflation print. They'll do all sorts of cartwheels to justify why they can still do that. It would just raise questions about whether or not they can go in December. But really important to note that we think that when we get into 2026, the new Fed, with the new Fed chair, whoever it might be, is going to gun for rates to be 3%, which means that you'll get the cuts kind of regardless of what the economic outlook is going to be.
Interesting. All right, Cameron, we'll leave our conversation there for today. That's Cameron Dawson, Chief Investment Officer, New Edge Wealth. Thank you, Cameron.